Good afternoon, everybody, online as well as offline over here. I think some of our participants, offline participants have also joined online. So good to have you again on this second day. And today we will have in the first session from Deloitte, Himanshu and his team. They would be taking us through two, I think, most important topics for corporates specifically, that is TDS, TCS, as well as refunds. I think most of the corporates, they would be dealing with issues in this regard. Most of the suggestions for Income Tax Act 2025 were for radical simplification of TDS and TCS, because it is just an advanced tax and complicating matters so much that does not help the taxpayers. And in the next session today, we'll have Shri Ramesh Patodia ji, who is a very, very senior faculty, author, and advocate practicing income tax for, I think, ages now, more than 35 years I've seen him. And so he will take through various other topics. So without much discussion out here, I think we would love to hear from Himanshu and his team. So over to you, Himanshu.
Thank you, Chairperson, for that introduction, and very good afternoon, everyone. The topic which has been allocated today to us to cover under the new Income Tax Act is essentially on collection and recovery of tax and also refunds. While the time given to us is 90 minutes, I think it's up to us whether we want to finish in 60 minutes or we want to extend it. So our suggestion is, to make it as interactive as possible and as relevant as possible, so that we can get maximum, from this session. Let's move on. Yeah. So essentially, I think if we look at the agenda today, what we have done, and I think my team has done a lot of hard work over the last 3 days to put up this presentation of about 40 slides, and hopefully I think we understand and at least take away some of the key nuances of how the TDS and incidental provisions are structured in light of the professed objectives of the government to introduce the new Income Tax Act 2025. Essentially, the way we have structured this presentation is, before really delving into the provisions per se under the new act, what we'll little bit spend time is how the TDS provisions have actually moved under the current 1961 law, and essentially what the government has done in the last couple of years. It has taken some steps to kind of simplify it, but we'll also go through it, and therefore that provides a good segue to us to get into the provisions of the new act as such. So moving on, I think as finance and tax professionals, we all love numbers, so we thought that we'll just start with a bit of statistics. While I think most of them would be aware of this, but at the cost of repetition, we thought that we'll just put in the total tax collections for the last 5 years, the direct tax collections, and also the percentage of TDS collections and advanced tax collections. So on the left hand side of the screen, you see the bar chart representing the TDS as the first column. The second one is on the advanced tax, and the third is the total tax collections. And really, if you see the numbers, in absolute terms, if you see, the TDS collections have obviously increased. In fact, it has nearly doubled in the last 5 years, from 4.7 lakh crores to roughly around 9.5 lakh crores. But obviously, with the percentage of advanced tax compliance also going in, both with corporate as well as personal taxes, in percentage terms, maybe I think the TDS collections have remained moderate. I think this trend is very, very important to observe. So today what we are discussing is the essence of the Income Tax Act. Whatever sections you consider from section 1 to 3 or 299 or 380, right, before the TDS and after the TDS, essentially this is the cash book of the government and where the entire collections fall in. So that's the relevance of the topic we are discussing today. And moving on to the next slide. Okay. So on this slide, what we have done is very simply, we have tried to say, okay, why was TDS introduced in the first place, right? And what was the original objective of the TDS? Now, if you really look at it, people who have been practicing for 15, 20 years and have been going through this subject, I think the TDS provisions were very, very limited if you look at the current 1961 law. It had minimal sections. I think it focused on particularly 4 or 5 type of transactions so far as domestic payments are concerned. And obviously, the importance on payment to indirect foreign payments was always there because of the recovery concerns. And the idea was to track, number one, the information on the transactions. Number two, TDS, you deduct at source and therefore it's easy to collect from a government standpoint, and therefore the cost of collections for the government is low. And thirdly, if you look at it, I mean, from an overall perspective, I think the fundamental philosophy was to prevent tax evasion and capture information. Now, this was true from 1961 to until mid of 2014-15, where we had limited number of sections, and thereafter, if you look at the middle, part of the screen, the number of sections has grown exponentially over the last few years. It went up to 30 sections by 2018, and from 2019 onwards, we have added another 13 new provisions dealing with new types of payments, compliance requirements, so on and so forth. Now, we'll all recall that we all started and we had sections up to 194 F, G, H, I, J, and then we kept on adding from 2019. We started with 194 M, then N, then Finance Act 2020 added O on e-commerce operator, then on purchase of goods, Finance Act 21 added on purchase of goods 194 Q, R, Finance Act 2022 added 194R on TDS on value of benefits of perquisite, so on and so forth. And the last one being 194T, which deals with 10% TDS on payment by way of remuneration to partners in a partnership form construct. Now, obviously, what has resulted because of this is a very complicated set of TDS provisions. Practically, each line of my profit and loss statement is today subject to, or potentially could be subject to, TDS liability. And therefore, it increases a lot of efforts from an organization perspective, one, to comply appropriately, and second, to maintain that data so that appropriate reconciliations can be provided at the time of assessment when it comes up at that stage. But having said that, I think this was an issue which has been represented to the government during the last 2 budgets, and at least some positive steps have been taken in the last 2 budgets, which we have selected only 4 or 5 if you look at the last column. But obviously, there were certain other measures also being taken to simplify the TDS regime. Now, if you look at the last year finance number 2, 2024 budget, most of the 5% or 10% rates under 194 G, etc., H, etc., were brought from 5% to 2%. So, there was kind of a rate reduction which has happened. So, most of the payments, if you look at it, 2% is the most frequent rates you will find in most of the provisions. The second is Finance Act 2025 expanded the threshold limits. So, therefore, that also gave some headroom. These limits were set years back. So, the basic threshold limits were increased under various provisions. The third one was some of the simplifications of some burdensome provisions, if I would use that word. One is the section 206 AB, which was increasing the TDS liability of the payer in case of non-filers, non-filer payees, right. So, that has been deleted, and we had this duplication of or overlap of the provisions between purchase of goods TDS and also on the same sale of goods TCS. So, this created a lot of ambiguity, and government came up with circulars, etc., to clarify it. Thankfully, in the last budget, this provision of TCS on sale of goods have been removed. The last one, decriminalization of the TDS TCS defaults, also that we have seen that in case of belated deposit, I mean, if you revise it within the same quarter, etc., it does not lead to prosecution provisions. So, these are some of the things which the government has recognized that yes, TDS provisions have to be rationalized, simplified, and these steps have been taken. With that, I think that gives us a good segue to go into the new provisions of the Income Tax Act 2025. On this slide, what we have done is, this is the core of our presentation. If we have understood this particular slide on the architecture of the TDS chapter and TCS chapter, I think the subsequent slides would be easy to consume for us. The first big message which the government has given is, there is no change at all in terms of rates, thresholds, etc. The idea of the government, if you recall, while introducing this law, there were 4 professed objectives. The first one was simplification of the law, to make the law of the act simple. The second one was to remove the redundant provisions. The third was to reduce compliance burden, and the fourth one was to reduce litigation. Now, as you would have attended earlier sessions also, you would have seen that the focus of the government was not to make any material changes or substantive changes while transitioning from the existing 61 law to the 2025 Act. So the idea was to first write it in appropriate English, simple language, make it easy for the taxpayers to comprehend, and then probably in the subsequent budgets we will see how the substantive changes are being carried out. So absolutely there is no change in so far as the rates, thresholds, etc. is concerned, and the provisions of the Income Tax Act 2025 is being completely aligned up to the changes made by the Finance Bill of 2025. So whatever gaps were there in the drafting of the original bill and the passing of the final act, that has been now taken care of through various representations, and also the select committee has done a great job in terms of coming up with more than 4,000 page report and analyzing each of the provisions and plugging some of these drafting errors. The second message is, if you look from the size of the provisions, right, I mean the TDS provisions, they have about 27,500 words under the 61 Act. It's now literally halved, right? So the overall act also has reduced from 5.12 lakh words to 2.6 lakh words. Similar ratio applies to the TDS TCS provisions, 27,500 words concised into 12,700 words. Currently, if we speak under the 1961 Act, we have about 69 sections dealing with TDS and TCS. I mean, we have done this wonderful job of 194I, IA, IB, L, LA, LB, LC, LBA, all of that. So what we have done under the new law, 43 TDS section has been comprised into one section only. So now we have this omnibus provision section 393, which deals with TDS payments of all sorts, including payment to non-residents. And again, the way this section 393 has been kind of structured, if you look at it, there are essentially 5 tables under section 393. The first table deals with payment to residents, and all the payments are covered under that particular table. The second table deals with payment to non-resident, and the third table deals with payment to any person. So the first 3 tables are basically on the categorization of the payees, and once you look at that, then you can figure out, I mean, very nicely the table has been represented. On the columns it has been said what kind of payment you are making, to whom you are making, by whom it is being made, what is the rate, threshold, everything is there. So that's one piece. The other 2 tables is, the fourth table gives you situations where TDS is not to be deducted. Like in case of payment of interest to a banking company, TDS is not to be applied, right? So similar exceptions are there in the fourth table, and the last table deals with the declarations. Various declarations which are given under 197, 197A of the current law, 15G, 15H, etc. All those provisions are being dealt with in the 5th table. So these are the 5 tables we have to keep in mind so far as section 393 is concerned. Once more I will repeat that this is the only section which deals with and consolidates with the TDS payments and the characterization and all other ancillary aspects. So that's one positive which has happened, but when we read section 393, I think we have to read along with the last bullet, section 400 and also section 402 of the new act. The reason why I say that, section 400 deals with the powers of the central government and the board to relax the application of certain TDS provisions. So currently if you look at it, 194O has that provision, 194Q has that provision, 194R has that provision. And using that power, the government and the board has come up with guidelines from time to time to remove the difficulties through detailed guidelines. Like in case of 194Q, we have a detailed guideline. 194R we have two sets of FAQs, right? So we have to read 393 and also TCS chapter along with section 400 and also section 402, which is an interpretation section, and there are 47 definitions in that particular interpretation section of section 402. Now what are these definitions? Nothing but whatever were the different definitions scattered under the respective sections, like fees for technical service under 194J or definition of work under 194C, right? All of that has been picked up from the main section and put it into section 402 for the sake of simplicity of reference. So 393 has to be read with 400 and 402 so that we get the integrated picture of the definitions and the other associated compliance requirements. Now coming to the TCS also, all multiple section 206C, 1A, 1B, 1G, 1F, whatever other alphabets are there, I think that has been consolidated into section 394. So only one section again which similarly deals with TCS provision 394. The other thing what we have done is, all these provisions relating to compliance reporting which were there in different sections of the 1961 Act, those have been consolidated and have been merged into single sections. So section 395 currently now deals with certificates. Now today if you look at 1961 Act, each section has a reference to lower deduction or option for nil deduction. So all of that has been consolidated into 395, including payment to non-residents, 195 LDC, all of those provisions. Similarly, the compliance and reporting section 397. 397 is our address which casts an obligation in terms of deduction, deposition, reporting, filing of the quarterly statement, so on and so forth. So 397 is the compliance and the reporting provisions. One important aspect here, and I think this is we would have faced in our practice, currently, that we may be getting lot of requests from our parties to actually submit revised TDS certificates from some of the old years, like 1920, 2021, 22, 23. Even as in Deloitte, we would have approached our clients to for revision in the TDS certificates where there were mistakes. The reason is because under the new law, the time limit to revise or file corrected TDS statements have been reduced from 6 years to 2 years. If you recall, Finance Number 2 Act of 2024 for the first time introduced the time limit of 6 years for filing the corrected statements. And this time limit has been trashed to 2 years with retrospective effect in a way, if I may use that word. Therefore, come 1st April 2026, all TDS statements up to 31st of December 2023 would get time barred. So we have to make measures both as taxpayers as well as deductors to ensure that all the rectification prior to that we have undertaken. We have approached our vendors, customers, whatever actions have to be taken has been appropriately taken. So 2 years is what is important, and this is very, very important. We have 1 quarter to kind of complete that activity. So if there is any kind of a takeaway from this or a call for action would be to kind of focus on this and get everything resolved. Insofar as unmatched kind of TDS or TDS reconciliation is concerned up to 31st December 2023. Okay, I think this is the last slide I will talk on, and then I will request my colleague Alpesh to kind of take us through each of the TDS provisions under the new law and the nuances of it. So what we thought was, so far as the select committee report is concerned and what amendments were being made in the journey of income tax bill introduction and the passing of the act in August 2025. As I said, lot of representations were being made, and on this slide what we have done is we have captured the essential points of concerns which were represented to the select committee, and consequent to that the select committee has heard the government, the stakeholders, and appropriate amendments have been made in the final legislation which was passed in the parliament. The first one, again you can say whether it's a drafting error or a substantive error, it's a matter of judgment, but these were very, very important provisions. The first one was that when the bill was introduced, the new bill, I think these provisions relating to nil certificate was not there. The option was only for lower deduction. So now section 395 has been amended to kind of insert the provisions for nil deduction as well. The second one, I think that's more of a catch-up amendment which was being done. So, Finance Bill 2025, if you recall, they provided this relaxation from TCS compliance in case of liberalized remittance scheme remittances which were being made out of borrowed funds from a specified financial institution for the purpose of education. And they said if you do that, then there is no TCS to be applied. In the new provisions relating to TCS under 394, that provision was missing, so they have added that. I think what is important is the fourth bullet also, the TDS on purchase of goods. The original bill actually was drafted in a manner that if the purchase amount exceeds 50 lakh, then the entire amount would be subject to TDS. Now it has been corrected only, and it has been brought in line with 194Q to say that only payment exceeding 50 lakh rupees, only on the excess you have to deduct. And the last one also is very, very important, adding circulars under section 536. Chairperson has just mentioned that we started this course with the repeals and savings because that's the thread or the engine which carries forward the Income Tax Act so long as it is relevant under the new act as well, and also the provisions of the new law. And if you look at section 536 subsection 2 clause J, what it said was whatever notifications, circulars, rules were issued under the 1961 Act, they will continue to have full force under the 2025 Act, and it will be deemed to come into force. So, nothing further remains to be done. This is extremely important. The word circular was missing in the original bill, but in the final act they have inserted the word circulars. The reason why this is important is in our interpretation of TDS provisions, we are mainly guided by the circulars. And the first circular, I mean the historical circular of 715, 1995 circular, we still refer, right? And detailed guidelines which have been issued in each of the sections, we still refer. So, this is very, very important. So, all those circulars which have been issued under the 1961 Act shall be deemed to have been issued under the new law. Nothing further needs to be done, and they will continue to have in force. So, on a lighter note, I was just saying that I really pity the new chartered accountants who will pass next year, because they have to actually study both the laws, the new law as well as the old law, right. So, we have practiced 1961, I think it is relatively easier to connect the dots, but I think now with people who are actually dealing with the subject, next 2-3 years, I mean the intensity of the overlap will be quite high. Obviously, we have faced this situation in indirect tax, we transitioned from multiple taxes to GST, but I think it took some period of time to kind of have a tapering off effect on the old law and really getting into the new law. So, I think we thought this would be a good kind of an overall slides to tell you the importance of the TDS, TCS, how the architecture of the provisions under the new Income Tax Act has been structured, and what are some of the misses which we had in the Income Tax Bill were later on plugged in the final draft of the Income Tax Act as was passed. And maybe once Alpesh discusses the provisions, there are certain open questions which we would like to also seek your feedback and interaction, right. So, today if you look at it, the TDS, we showed you that 9.5 lakh, 10 lakh crore is the total TDS collections. And if you go further down into it, majority of it, and you can look at it into your organizations as well, 75, 80, 85% would be either payment of TDS under salary chapter or under payment to non-residents. The rest is just 10, 15, 20%, maybe plus minus 5%. I am taking the tolerance estimation range. So, therefore, what we are saying is out of 10 lakh crore, if TDS is, that is the number, and 15, 20%, 1.5, 2 lakh crore is on TDS other than salary and non-residents, do we really need TDS chapter at all on domestic payments? Today, you look at matured economies like US, Australia, UK, they do not have TDS on domestic payments, they have on salary and non-residents. My bucket from a government's perspective, you can have a strong reporting mechanism, right. So, we as payers report, we come out with some reporting, there is SFT reporting, but we can come out with a structure of robust reporting so that government has complete information flow. But can we think about this kind of a radical change to say, okay, we'll completely do away with the TDS on domestic payments, other than salaries and non-residents? I mean, see the amount of compliance burden it's going to ease. You won't have all these interpretation issues whether TDS would apply to year-end provisions, what is ad hoc provision, what is no ad hoc provision, so on and so forth. Bulk of the prosecution cases, disallowances cases under 40A is emanating from such issues. 1.5 lakh crore is, if that's the number, can we look at some of those drastic numbers? Can we at least look at, eliminating, is there a need for a TDS certificate today if you really look at our systems? What is the practical relevance of issuing a TDS certificate today? Right? So therefore, when we say that there are 4 professed objectives, namely simplification of the language and reducing redundant provisions, government I think has done well on these 2 pillars. But where is the reduction in the compliance burden? Where is the reduction in litigation? So while the rules are to be notified, I think these 2 pillars is something where I think we should expect more from the government under the new law. Maybe some of these are quite radical, what I have explained or I have just expressed, but I mean just reflect upon it. It's a food for thought, whether it makes sense, doesn't make sense. The cost of collection, the compliance burden on the taxpayers, every month you have to go through this process of reconciliation, deposition, filing of the quarterly TDS statement, so on and so forth. Maybe I think if that is removed, the size of the TDS, the act will further reduce by another 20%. You have a fall-on effect on the other provisions, right? Associated penalty provisions will go, interest provisions will go, lot of provisions will go. So with that, maybe little bit of a different thought, I'll pass on the baton to Alpesh. But I'll stop here. If there are any immediate comments or questions we can take. Otherwise, I'll request Alpesh to get a little bit deep into the discussion.
I think I will start with 1 or 2 points, Himanshu. Thereafter, maybe participants online as well as here can raise any issues, if any. One is, rightly said, and from Bengal Chamber, we are representing vehemently ever since the request for comments came on the Income Tax Act 1961 in October 24. And this is a very good point that if 10% of your TDS collections is from domestic, why not scrap domestic TDS, TCS? We will certainly represent this. On this TDS certificates removal, TDS, TCS certificates removal, we are representing from last 2 years. We have represented at every level. Very recently, 1 month back, CBDT member PK Mishra was here. We represented, and there was his commissioner was also there. And he said, see, TDS certificate is for ease, it is a help for the taxpayers. It is a taxpayer services. I said, why? He said, see, there is a section 205, which says that if there is a default, then then there would be a recovery if there is a default in your TDS payment by your payer. But if you have the certificate, you have a footprint which will not allow you a credit, but actually will save you from recovery proceedings. So, this said, I mean...
I'll just maybe come on the second one. I don't agree or subscribe to that argument. Today, do you have a GST input trading ITC certificate?
Absolutely correct.
You get in the system. So once the deductor deducts, uploads the information. What I said was have robust reporting system. So once you have that reporting system, it will come in my electronic books, you call it. Otherwise, what is the purpose of 26 CAS, TIS, EIS? That's one point. Second is when we say that we are moving to a 5 trillion, 4 trillion GDP, we are going to be number 3, number 4, our tax system should also reflect that.
Absolutely.
So if countries like UK, Australia, US, etc. doesn't have, why there is a need for this? I'll just probably stop there.
Yeah. One more point here on this 536(2)(j. We were discussing yesterday this addition of the word circular by the select committee. Yeah. So that's a very good move, as you said, that they have said that any circular which is passed in the old law will be applicable in the new law. Now, but they have also said, provided it is not inconsistent with the new law. So on this 194R, there is a circular which says that on post-sale discount, TDS would not be applicable. But that is actually in conflict with the law, which says that it is a perquisite, but TDS will not be applicable. So how do you view this?
So good point, Vivek. So if I look at the clarification which is being issued, it is issued in the context of 194R. So the argument is apparently what you said, there is an inconsistency. But is there a consistency in that inconsistency? To say that, what is the government saying? That we are keeping everything same and there is no intent to make any material change as per the FAQ. So therefore, to that extent, I mean, and at the end of the day, you can say circulars are also binding on the department.
Yes.
So to that extent, you can take that logic and say it has equal force as in law, so long as it is favorable to the taxpayer. So
We have one question in the chat box. I'll message you. From Hindalco.
People are there online today. Okay, so one query from Hindalco. Presently, tax on accumulated PF balances of recognized provident fund are deducted under section at the rate of 10% under section 194A of the IT Act 1961. Has it been removed during the current fiscal? From Mr. Shomo Banerjee, Hindalco.
no, I think it's there. TDS on accumulated balance. 392 it is there. It is consolidated under 392.
Okay.
Along with the 192 and 192A has been compressed into 392.
Okay. So, yeah, Mr. Shomo Banerjee, under section 392, it is consolidated. If there is no other question, I think Mr. Alpesh, you can carry on.
Thanks, Himanshu, for laying down the context and discussing the landscape of TDS provision, how it has evolved right from 1961 till the current act. So, what I will discuss is, we will discuss section by section of all the sections of chapter 19 for TDS and TCS, then we will move to advanced tax, then refund. Section 390 and 391, this is the core fundamental section for the prepaid taxes, that is the TDS, TCS and advanced tax. If we see the old act 1961, the corresponding sections were 190, 91, 199 and 202. So, all these three sections has been consolidated into section 390, and essentially policy wise this section is same and there is no substantial change which is there in. Or reduction in the number of words and pages is there in section 392 to 393. 392 talks about TDS on salary payments. So, section 192 and 192A, which was there in 1961 Act on TDS on salaries, now it corresponds to a single section 392. So, there is no substantive change which is there in section 392 vis-a-vis 192 of the Act. One point was which Himanshu had discussed earlier on PF withdrawals, which point was missed in the bill, has been clarified by the select committee, and now in the Act it is there. So, TDS would be deducted at the rate of 10% on PF withdrawals of accumulated balances. Coming to the next section, that is 393. So, I would say this is the most important of all the sections which is there in this chapter. Most of the amendments or reductions in the words is there in 393. So, what has done is, the lawmakers, what they have done is, all the paragraph which was there in section 194 of the 1961 Act has been tabulated in 393 for the TDS and 394 for the TCS provisions. Even after cutting 45% of the total words, the essence, all the provisions are still there. There is no change in law even after reducing so many words. So, were these words important? Actually, that is why the government has come with this amendment. So instead of spreading 43 sections which was there, now we have a single table in section 393 which has been bifurcated into 4 portions for residents, for non-residents, for non-deductions, and for all P. And in each of the table, once we read, so like in the old act, when we need to determine how TDS is deducted, we need to go through the relevant provisions one by one of section, whether this is applicable or this is not applicable. Now in the new act, because of the tabular reference, it's quite easy for everyone just to pinpoint where the TDS is applicable. After pointing out the nature of the payment in the table, it's very easy identifiable what is the threshold and what is the rate of tax. So if earlier someone used to spend might be 5, 10 or 12 minutes to identify the rate of tax for a particular payment, now it would be quite safe. So the complexity is quite resolved in this new act for TDS payments. So once I move on to the next slide, I'll show you how the old provision was there and how the new provision is there in the new act 2025. So I have taken this example for in case of rent. So earlier in case of rent, 2 sections were applicable, 194I and 194IB. So one can see like hundreds of words are there when we need to analyze payment to rent. But on the right hand side of the screen, you can see that in the new act, we just have 3 columns. Threshold is easily identifiable, rate of tax is easily identifiable, payer, payee, the nature of payment. So one needs to just identify the row, and it's quite easy for anyone to identify the rate of tax and the threshold. Moving on to the next slide. So similarly, like in 393 with respect to TDS provisions, now 394 dealt with TCS provisions. Now coming to section 395. So 395 talks about lower or nil TDS certificate. So the nuance with respect to nil was identified by the select committee, and then in the final act it was there. 395 is with respect to lower deduction certificate, so which corresponds to 197 of the Act 1961. So in 1961 Act, if we read section 197, it had specific sections wherein we could apply for LDC. But here in section 395, it is holistic, entire TDS and TCS provisions has been covered. So
I just have one comment on the previous slide. In fact, 2. Maybe it's little premature to call the 1961 Act an old act. That's on a lighter note. But on a more serious note, I think what also been done under 393 is the similar payments have been combined, right? So as Alpesh mentioned, the 2 sections dealing with rent, they are combined together. The heading is rent. Similarly, today you look at it, there are 2 sections dealing with commission payments, which is the general commission payment 194H and insurance 194D, right? So they have combined and called it commission. Similarly, payment income from market, specified mutual funds, etc. So what they have also done is they have consolidated everything.
So section 397 deals with compliances and reporting. So section 397 subsection 1 requires that every person who is deducting or collecting taxes needs to obtain a TAN number. So here we have plotted the old income tax 1961 Act section numbers and the new Act 2025 section numbers. So both corresponds as the same. So in 1961 Act, there was section 206AA which deals with the situations wherein PAN is not provided by the payee, and 206CC talks about where PAN is not provided by the collectee. So in the new Act, we see that 206AA and 206CC both has been combined to form a single section, that is 397 subsection 2. So like since 206AA was for TDS, 206CC was for TCS. Now TDS and TCS both is covered under section 397. the thresholds and the rates are all same, which was there in 1961 Act. Section 397 subsection 3 talks about compliances once the deductor or the collectee has already deducted and collected tax. What are the next steps? So, in 1961 Act, the section was section 200, 206A and 206C. All these three sections has now been combined and unified to form section 397 subsection 3, which deals with deposit of TDS within the specific timelines, then filing of returns and statements, and providing these certificates to the and related information to the deductees and collectees. So, earlier 3 sections were there, for one for TDS, TCS and for banking companies. Now, all 3 has been combined to form a particular section 397(3). What happens when we deduct TDS and we do not deposit or we do not deduct? So, there are consequences which was there in the old Act, and similar replication is there in the Act 2025. So, the earlier 1961 Act section 201 and 206C talked about consequences for failure to deduct and collect tax. Now, the new section is 397. So, all the provisions like the assessee in default, if the deductee has deposited the TDS, if the deductee has considered the income in the return of income, considered the income in the ROI and has paid taxes, then the deductor won't be considered to be as assessee in default. Similar provisions was there in the 1961 Act, has been now imported in 2025 Act as well, and the interest rate which was there for 1% and to 1.5% is same in the new Act. Coming to the next section 399, it talks about processing of withholding tax statements. So, in 1961 Act, section 200A and 206CB used to deal with processing of TDS statements and TCS statements. Now, both has been combined to section 399, wherein TDS as well as TCS statements would be processed. So, earlier, like we used to file TDS returns separately, TCS returns separately. Now, what is understood is in the new Act, both would be there in a single form, although rules are still awaited, and there would be a single standardized intimation which would be there for both TCS and TCS. So, in this section, one can say that the government has helped the assessee to reduce the compliance burden. Other sections with respect to TDS and TCS, section 402, which Himanshu spoke about, which consolidates all the definitions, all the terminology which is used in TDS sections in the old 194 section has been combined and has been put in section 402. So, this helps the readers to reduce the ambiguity and prevent dispute because of unclear terminology. Moving, any questions?
If texted. Okay, one question from M Junction. Rule 26B read with section 192(2)B, which necessitates an assessee employee in parlance of our organization. What documents are required to be collected from an individual for allowing tax credit for tax deducted from other than salary or tax collected at source? Is it 26AS, and under what section under ITA 25 replaces this section 192(2)B?
So, with respect to the documents which are required to satisfy for the additional income which is there in the salary payments, it would depend on the nature of income. If it is suppose it's a interest income, then bank certificate would be an ideal document. if the income is in the nature of might be a capital gain, or then the document from the depository would be an ideal document. With respect to 192, the similar provisions which was there in 192, I believe that 392. So it's there in 392.
Yeah.
So as per the new form which has been introduced, which is 12B AA, the problem is resolved here, wherein the employee gets a chance to furnish all the relevant data to the employer so that it is adequately captured and no income is left out, as questioned by the audience. So the new form will help us in compliance of the same.
So that's the amendment which came in last year, where the employees actually can declare all their TDS outside of this also to the employer for potential 360-degree coverage of the income and the tax.
No, so there is this new form which needs to be filled up, 12B, and whatever number is that this new form has in the act, new act, and the documents, he's more concerned about the documents. When if his other income is liable to TDS, a TDS has been deducted in that income, then what documents should M Junction rely upon to give him the due credit under 192(2)B? I think that maybe the new law will further lay down. Any other question?
So same will be there, no changes. Even forms might be changed or. Yeah. But suppose I have some invoice of 31st prior to 31st March 26 and I make the payment post March. So then what will be?
Anything up to 31st March is still 1961.
Yeah, suppose the invoice date is of 31st March. My vendor has given me invoice for financial year 25-26, but I process the invoice in 26-27 when it is accruing in my books.
That cutoff will happen, but the point is payment of credit whichever is earlier. So if you are not recording the provision on 31st, then it is not financial year 25-26. Then it is 26-27 under the new law.
Okay. Okay. Thank you.
So I think to add on to what Himanshu said, for this again you need to go into section 536, transitional provisions. So now whatever is there applicable in the old law, so TDS on a particular invoice, in my view, it is on credit or payment, whichever is earlier, right? You have neither made the, since you have not created the provision also, right? Or you have created the provision.
Yes, based on the provision, during the means I have a quarterly provision and I have deducted the TDS, but I get the invoice which is dated, means which is for my vendor has given the invoice at the end of the year. For them it is falls under the different financial year.
So then I think
I
25,
think
26.
it's straight away. I mean, cut off. I mean, if you are taking the expenditure as a deduction in financial year 25, 26, even you are deducting then it will be under the current law, right?
Yeah, but I have that time I would have paid it under 195. I would have given the certificate into I filed 27Q. But since I am making the payment in next means Income Tax Act new
That
form
doesn't
will
matter.
be there.
Your transaction is within 25, 26.
Okay.
The TDSable item you are recording in the books of 25, 26 in the financial year. So the payment of the factum of payment in tax year 26, 27 will not have a bearing.
Okay.
So in the new section 393 and 394, which pertains to TTS and TCS, one very good amendment or rather change I would say has been made is that they are referring to the definitions of the new Income Tax Act. I will just take one instance wherein supposedly a TDS is required to be deducted on a joint development agreement. So now what they have done is to have a clarity as to what joint development agreement is. Now they have stated that the TDS is to be deducted as per the agreement, as per section 2 of the Income Tax Act. Now what they have done is they have defined properly what is joint development agreement. So instead of explicitly saying joint development agreement directly, they have explained it in more detail, and they want the taxpayers to first refer the definition more precisely so that there is no ambiguity. So this is one of the clarity which has been given in the new act, and it's covered in section 392, 393 and 394, all the three main provisions. Thank you.
Yeah. Tax. So we sections which was there in the 1961 Act, like from section 207, now it's 403. Overall, in a single line, if I say there is no change in the rate, there is no change in the threshold, only there are some structural and terminological changes which is there, and the formula has been mentioned for easy reference of the readers. So apart from there, no specific changes are there in the advanced tax module. So just quickly, I'll just compare both the sections which is there in the 1961 Act and 2025 Act. So 207 used to talk about 207 of the earlier Act talking about advanced tax. Now it's 403. The basic condition, the threshold of 10,000 there in section 208. It's there in now section 404 of 2025 Act. Now the computation mechanism which was there in 209 of the old Act, now it's there in 405. Coming to the next section, 406 and 407. So earlier in the 1961 Act, section 210 talks about the basis on which tax is required, advance tax is required to be paid. Now there are two sections for this. Section 406 and 407. 406 is in case of self-payment of advance tax, and 407 is basis if any order is passed by the assessing officer demanding to pay any additional tax. So the language and everything of 210 remains in 406 and 407. What has changed is structure, clarity and terminology and reorganization of the section which is there. So it would help us to read simpler and reduce ambiguity. The next section which is there, 408, which caters to the timeline. Here the timeline, so the timeline here is in the form of a table in the Act. So it's earlier, like when we used to read the timelines, we used to read in a paraphrase form. Now it's quite easy to read table which is there in 408 Act, 408 of 2025 Act. Section 409, there's no material change which is there as compared to section 218 of the old Act, which deals with default for failure to pay any taxes. Section 410, corresponding section is 219 of the Act 1961. It deals with credit of advance tax. Whenever any advance tax which is paid, that would be credited in the books of the assessee. The assessee would be able to take credit. I'll move on to the next part, part D, collection and recovery. In this slide, we have plotted the section numbers which was there in 1961 Act vis-a-vis the section numbers which is there in Act 2025. Like similar to the earlier provisions of advance tax, there is no substantial change which is there, no policy change which is there in this part as well. So that's why I quickly speak on the sections which is there. So section 411 which talks about assessee to be in default where if any notices is issued and a timeline is given to the assessee for a notice of demand. If that timeline is not adhered or any response is not filed by any company, then the assessee would be deemed to be in default and collection mechanism would start. In section 413 talks about the modes by which one can collect, the tax recovery officer can collect the outstanding demand which is there. So by way of immovable property, movable property, or by way of arrest warrant, or by appointing a receiver. So flexibility is given to the tax recovery officer. He can adopt one mode, multiple modes simultaneously. So 414 talks about the jurisdiction wherein a TRO can be appointed. 415 talks about the stay proceedings, like if in a particular certificate the TRO is allowed to collect X amount, if that amount is collected, or if in the view of the TRO such amount need not be collected. So that things is there in section 415. Now coming to next section 416 which talks about other modes of recovery. So 416 it is similarly worded as 226 of the old Act 1961. So, but one point to be noted is like 226 would continue to apply in case of legacy assessments, and like in from 1st April 2026, section 416 would apply. So 421 talks about if there is any recovery proceedings or suit proceedings which is there in case of a company in other law, wherein the assessing officer is requested by the other government department to collect to initiate recovery proceedings. So these are there in section 421 of the Act, and in case of non-residents, it's 422. Now coming to the next part, part E, interest chargeable under the Act. So I have a single slide on this. So 4 sections were there, 234A to 234D. Now section 423 to 426 in the new Act, there are similar provisions. Only like we have tabularized format for the timelines, but the threshold, the tax rate and everything which was there in the 1961 Act is same in 2025 Act. Moving on to part F, levy of fee. Similarly, here also the amount of fee which was there in 1961 Act is same. So sections 427 to 430 deals with levy of fee for different mistakes which is there in case of late filing of TDS returns or in case of late filing of return of income. So similar provisions were there in 1961 Act as well. So now coming to the last chapter, chapter 20 for refunds. Even in this section, even in these 6 sections for refunds which is there, there is no change from the 1961 Act. Only like the language is easy to read and tabularize and structure provisions has been there in 430 from sections 431 to 436. So provisions remains changed, only the presentation is changed. Section 437, the corresponding section which was there in 1961 Act is 244A, which deals with interest on refund. So there's no change in rights or conditions for claiming interest. It is the same which was there in 1961 Act. Now we have already discussed the changes which was there in chapter 19 and chapter 20. Now the question which comes to our mind, are we ready to implement the new Income Tax Act? Have we made any developments internally in our tools to ensure that we are ready with the new 2025 Act? For example, like anyone in like present here, like have we made any modifications to the ERP package? Because earlier there were a number of sections in 194. Now now we have a table concept. So changes would require to be made in the ERP software and accounting software. That takes time. If the implementation date is 1st April 2026, we hardly have 3 months, and changes in SAP and all takes time. So like, has anyone started doing? No discussions.
Wait for the rules.
Yeah. Like when we do the ERP modification, we need to verify all the customer data and vendor data. That would be important while undertaking the ERP modifications. The contracts might need a revisit. The invoice mechanism which is there from the ERP logic might need a new revisit because of TCS provisions. Due to the change, there might be lag in data for the deductor, and that amount might not reflect in our 26AS or AIS statements, and it might require us to file additional advanced taxes if the TDS is not reflected. So that point is important from cash flow perspective. if the challans of the current year, if they are unutilized, whether we can carry that in the next year, that's an important question because the section number would change. So these were few of the impact areas because of the change in the TDS and TCS provisions one needs to keep in mind once the rules come out. In this slide, we have included few points wherein like what could have been included in the 2025 Act or the misses which is there, which could have formed part of this Act as well. So in case of home buyers where the seller is a NRI, so if a resident buyer, he is required to obtain a TAN and deposit the tax deducted and file the TDS returns. But in case of residents, a simple form is there if you buy from a resident buyer. So that provision is not there in case in this 2025 Act. So if this could have been included, it could have been easy for a resident buyer buying a property from an NRI. Simplification of TDS rates, Himanshu spoke about it, whether TDS is actually required as on date because it increases the compliance burden. With respect to this 26AS, we already have Form 26AS wherein TDS credit is already reflected, but whether we require a TDS certificate if such amount is already appearing from a government portal form. TDS on purchase of unlisted securities, no clarification is there. So this question was asked by the audience. So still there we don't have any clarification. With respect to TDS on dividend paid to Investor Education Protection Fund, there is no clarity as such whether TDS is required to be paid or not, because here the party is not identifiable. So one may want clarification in this regard.
So I think very, very good presentation. Any questions from anybody?
Yes, sir. In the chat box, we have two questions from Pavitra Chakraborty, sir, from Anjunction. This is all.
Mr. Chakraborty, if you can unmute and ask your two questions, please. Okay. I think I will ask one. Can we, so you have already touched upon this, Alpesh. Can we adjust excess TDS paid under section which tax deducted against another section under ITA 25?
So specific rules are not out, but yes, we can.
Should, yeah, I think they will allow,
Yeah.
there would be a functionality, but again, procedurally something might be required to be done,
Right.
maybe in the new act. Maybe there will be a new form, transitional form to transit all of these credits to the new act, something of this sort.
Maybe just 30-second interjection on that. We are currently having a live case where one of the clients is having multiple TANs in different jurisdictions, and in one jurisdiction there is excess TDS, on the other one there is a demand on the portal. So again, if it's a national tax, one tax, whether we should, and this is another step which one could consider, right? I mean, ultimately it's a central tax. So why jurisdiction should come in the way of, and this is a situation where the TDS officer, where the demand is showing, has actually attached the bank account, despite we submitting the proof that we have a refund in the other jurisdiction. So these are some of these things I think one needs to address and not jump into such serious consequences as attachment.
Yeah, right. In fact, just in addition to this, we had issue from one of the members, I think Siemens. Some Siemens is, I think somebody is there. So they had a very interesting point that, but this linking of TAN numbers and PAN number. TAN number should be PAN based, so that just like GST, various state numbers, and certainly, like in GST now they have started transferring the cash balance from one state to another. Same thing should be there in TDS, TCS also. Right. So, to answer your question, I think Mr. Chakraborty, there would be something, of course, in the new act when it will come over. So another question he has, can excess tax paid under a particular, it is the same question. Any other question?
In fact, Section 536 repeals and savings again very clearly says that any rights or which are vested under the current law or any options which are being exercised, any vested rights, that will continue, that will not impact, right? So
Anybody else? Any question?
see, therefore, we have to visualize, the income tax portal having two engines, right? One engine will cover the 1961 and the associated proceedings. So that engine and the workflow would be separate, and there would be a separate engine in the income tax portal which will be governing under the new regime. So accordingly, depending on the nature of the proceedings, the notices, etc., will get bucketed logically into the respective engines, and therefore the consequential workflow would be generated out of that.
Yeah.
That is a process of adjustment of refund with the demand, right? So suppose I have refund in 27-28 or financial year 20, tax year 27-28, but I was having some demand in earlier financial year. So will that be adjusted? But how that will happen, because both are two separate acts.
No, separate act is fine, but as we said, 536 is our answer, right? If it is rights, it is obligations also. So both goes hand in hand, right? So any kind of a refund under the current law, that's my vested right. So if there is any payable under the new law, it retains the character of the thing. So, and even you have the set of provisions under 245, what we currently have under 245, you have equivalent provisions under the law, right? So that set off, and it's explicitly there under the law.
Yeah, so rightly we discussed this under 536 yesterday. While, under the law it is there, but procedurally how it will happen, as Himanshu rightly said, I was speaking to one very senior officer. He said, as of now, our ITBA 2.0, that is not streamlined. We have not started working on ITBA 3.0, which should be ready by 31st March 2026. So procedurally, all this excess paid in earlier law, refunded, legally, yes, 536 2A, any right, obligation, privilege given to you, that will carry forward. But procedurally, again, you need to see how it will be done.
We were not there to experience the transition from 1922 to 1961,
Yes,
but
yes.
we are certainly here to see from 61 to 2025.
We are privileged, actually, all of us, I mean, to witness this historic change. Yeah. One more question from Mr. Chakraborty. Mr. Chakraborty, if you can.
Appropriate correspondence, everything will happen on a workflow basis. So I think that they will use and they have to use. Otherwise, it will be chaos. I think the system will fail. So, because come 1st April, I think at least from a taxpayer's perspective, we have to be ready with all the TDS provisions, etc. Government still has some time. So, unless the first set of proceedings happen, but to answer your question, they will be using it. Even today, they are using some of AI. If you look at the Inside project, if you look at the recent nudges which they are doing to file the returns, so on and so forth. So information, I think they have it and they are leveraging it appropriately. And we would expect at some point in time, like Honorable FMS said that the 3 systems of customs they are going to integrate, IceGate, ICIS and RMS shortly. So we'll hope this to integrate and logically flow.
Yeah, so they will certainly integrate for better collection. How much for facilitation, that needs to be seen. And with AI, if it goes wrong sometimes, in fact, so many judgments we are seeing of the ITATs, they are being called back because AI have given wrong case laws. So we need to see. Yeah, but a very important point which Himanshu and his team has made is that specifically for this TDS, TCS, I think as corporates and as deductors, we need to have our own systems ready. We have only 3 months now left because the entire, sections, etc., changing, to change our ERPs and how to fetch that data in the right format and thereafter upload. I think in July 2026, that will be our first return for the new TDS forms, and in May 2026 will be our first TDS challan. And from 1st April, we need to deduct TDS under the new section and new tables. Any other question, or we can?
Sir, I'm Chinmoy Sarkar. I have one question.
coding the account charter mapping under the ERP, right? Because everything is automated. So one has to really clearly define the account master charter, true references to the nature of the payment, linking with the nature of the payment to the vendors. That's one. The second one, really also internally, I think as in tax teams and tax organizations within the company, how we are doing this awareness within the larger team. Within the tax team, and also currently if you look at it, our stakeholders as tax team is also, you know, the purchase department and various other departments. So some of the documentation and system changes, how the different teams in the organization is working seamlessly, is that's where the capacity build, the awareness, you know, and the awareness of the provisions, and once the rules and forms are being issued, integrating that into our systems, etc. So those are the activities which we have to do. One is purely from a technical standpoint, the awareness, the discussions and cohesive approach of the tax team, the purchase team and the other stakeholders, the finance team. And the secondary is really the technical changes in the systems and the processes and the documentation.
Thank you, sir. Thank you.
No other question. Okay, so I think we have had a very, very interactive session, and you know, deep dive into the TDS, TCS provisions, the refund, advance tax provisions, etc. So thanks a lot to the entire Deloitte team, Himanshu, Alpesh, and over to you, Sharbani.
Thank you. Now we will proceed towards our next session, maybe after 5-10 minutes, so we can have a tea break in the meantime.
Offline, online participants, you can also have a tea break at your offices and homes. 5 minutes only.
Good afternoon again. Now we will have our next session. We are pleased to have with us our next faculty, Mr. Ramesh Patodia, who is a renowned advocate and chartered accountant with 40 years experience in practicing mainly in consultancy and litigations in the field of direct and indirect tax, FEMA, and other civil matters across the courts and tribunals in India. He has also written several books on professional topics, and he is also a trustee of Sri Rani Satiji Mandir, Junjunu and Gayatri Foundation, Kolkata, and actively participates in social work. He is also associated with several professional organizations on various capacities. We are pleased to have Sir with us today, and I request Sir to take the session forward.
Over to you, sir. There are lots of topics, you know, very, very important topics, including return of income. So over to you, and the audience is waiting to hear from you.
Okay, friends, good evening. Vivek ji Jalan on my left hand side. I am thankful to Tax Connect as well as BCCI for giving me this opportunity to discuss and deliberate with you this very, very important topic, Income Tax Act 2025, which is going to be implemented from 1st of April 2026, friends. And now, like we are gearing up, because now I think everybody has complied with the regular compliances under the Income Tax Act 1961 as far as assessment year 25-26 is concerned, having filed the returns. Now we have to concentrate on the next year, including the planning for advance tax for assessment year 26-27 or tax year 26-27. There will be some confusion for few months and years before one gets accustomed to tax year instead of assessment and previous year, friends. Because as all of us know that the concept of assessment year and previous year has been done away with as far as Income Tax Act 25 is concerned, friends. Friends, the topics that has been asked for to be deliberated by me, they are related to, like, broadly they cover from section 236 of the new Income Tax Act to basically it's about 331, 32 of the Act. So basically there are about 100 sections as such. And friends, frankly, when I was going through the Act 2025 over last few days, at least in respect of these sections which I will be deliberating with you, one thing I can tell you with conviction that the new provisions appear to me to be old wine in a new bottle. That is all I can say. Because I think that most of the provisions which I will be discussing with you, they are more or less similar to what is there in the Income Tax Act 1961. So I think you need not worry from that point of view that you will have a tough time in adapting to the new act. At the same time, friends, there are few, what should I say, there are few things which I noticed as part of my understanding, which I think could have been avoided when the Income Tax Act 2025 is coming and it claims to simplify the things, not only in language but otherwise also. But I can say for sure that at least in relation to those controversies which I will be pointing out to you also, and I will invite your opinion, your discussion, your comments as I deal with them, friends, that they are going to create litigation, of course, in relation to those things, friends. With this, friends, let me start with the provisions, friends. The first provision is section 236 of the Income Tax Act. Acha, I want to, frankly, I would like to know from you, since as I told you that there are about 100 sections which I am dealing, and there are a lot of sections where I do not find any change at all. So, do you want me to run through one by one section, every section, or do you want me to highlight the particular things which I wanted to discuss with you, basically? I am okay with both the things, and those who are online, I don't know whether they have any mechanism for giving their comments on this particular aspect, friends.
Yeah, they can always unmute and speak up.
So friends, then I think let me give you my views on the points which I have noticed, rather than running through the sections, because you can do it at any time at your leisure. And one more thing, friends, there are like internet, there are other platforms available where the comparisons are available, and artificial intelligence, ChatGPT is always there for you to do that. So friends, one particular provision which I would like to place before you is directly, I would take you to the provisions of section 281. 281 of the Income Tax Act, friends. And since this is related to reassessment under the Income Tax Act, and I had the opportunity to write a book on income the reassessment provisions under the Income Tax Act also, friends. So, 148, yeah. So, friends, 281 of the Income Tax Act. 281 is, the old section is 148A. 148A of the Income Tax Act, if you are aware, it was introduced in the statute book on and from 1st of April 2021. When the reassessment provisions were amended to make it kind of that before a notice is issued for reassessment, the assessee has to be given a so cause notice in the form of a notice under section 148A, and the assessee can give an response to the so cause notice, and thereafter the assessing officer will pass an order, which was order under section 148A subclause D earlier, though in the new in the act which is there now, it is 148A subclause 3, and thereafter the assessing officer will pass the order notice order under section 148A3 and issue the notice under section 148. This was the mechanism, or this is the mechanism in the act till now, which is now incorporated in the form of section 148 is now 280 and 148A is now 281. So, here friends, the provisions of section 281 within bracket 4 subclause 4 says, the provisions of this section shall not apply to income chargeable to tax escaping assessment for any tax year in the case of an assessee where the assessing officer has received what. So, therefore, this section says that this notice is not required to be given in these cases. And what are those cases? Number one is, if it is a information under the scheme notified under section 260. Therefore, if you are aware, under the existing law, there is a provision section 135A, and under 135A, the government has notified a scheme called e-verification scheme, where your returns are verified, and if during the course of such e-verification some discrepancies are noticed, then you are given a notice under section 133(6), and in pursuance of that e-verification e-verification scheme, a report is prepared and then it is subject matter of reopening. So, this is same, there is no change in this. Then second is directions issued by the approving panel under section 274(6). This is important, friends. Directions, if any directions have been issued by a approving panel. What is approving panel? Friends, you must have heard the phrase GAR. GAR. GAR is a very, when you listen the word GAR, we all get frightened that it has got something to do because general anti-avoidance rules. So, GAR, in order to deal with GAR, the Act prescribes in section 274 setting up of a approving panel. That approving panel will look into that, and approving panel consists of 3 persons, the chairman of which is a retired judge of High Court. Chairman of GAR is retired judge of High Court, and one of the member is Principal Chief Commissioner of Income Tax or Chief Commissioner of Income Tax, and another member is a reputed academician or any other person who is an author, say in the taxation field. So, these are the 3 people who consist of approving panel, and thus this section says that if there is any direction issued by approving panel, then the so cause notice which is required to be given under section 281 need not be given. Fair enough. And now you see, there was a query regarding this, that why you by the standing committee in relation to this, that why you are bypassing the issuance of so cause notice in such cases. The rationale which was given is that, look, the approving panel which gives the directions under section 274 it gives such direction after getting or after giving the opportunity of natural justice to the assessee. Like he is given a notice that I am approving these directions, do you have anything to say? And after taking my objections, they issue these directions. So therefore, the standing committee says that, look, I have already given a I have already given an opportunity before the directions were given. So there is no need for giving any further so cause notice on that. So appears to be a reasonable proposition, friends. But friends, when I see section 280, section 280 deals with issuance of notice under section 148, and 148 under the earlier law or rather the present law only, in barring some cases, it is required to be issued after taking approval of a sanctioning authority. For issuing the notice under section 148, sanction of an approving authority, which is mentioned in section 151 now, is required. That sanctioning authority concept is there in the new act also. Now you see section 280 subsection 5, please see. Section 280 subsection 5, please open. Section 280 subsection 5 says, no notice under this section shall be issued without prior approval of the specified authority where the assessing officer has received. Now you see subclause B of this section, directions from the approving panel under section 274B. So therefore, friends, what I am trying to highlight is that even in case the notice under section 148 or section 280 under the new law is being issued, in pursuance of the directions of the approving panel, the assessing officer has to take the approval of the sanctioning authority, which is given in section 284 of the new act. Now kindly see section 284. Section 284, the specified authority or the sanctioning authority is additional commissioner or additional director or joint commissioner or joint director. Friends, I fail to understand when the approving authority consisting of a chairman being retired judge of High Court, principal chief commissioner of income tax, a academician, they have given the directions, and the standing committee and the lawmakers find it not appropriate to give a so cause notice because it is already there. But they say that even if the directions has been received, Mr. Jalan has got what I am saying, even if the directions are there, the approval of the specified authority under section 284 has to be there. Who is nothing but a assessing officer. Huh? So what do you say? This provision is absolutely ultra vires. I hope all of you have got what I am trying to say. If you want to, if you have not understood, please come to me. I will explain you what is this. When something has already been approved by a retired judge of a high court, the act says that it must be approved by a joint commissioner or the assessing officer, otherwise you cannot issue the notice under section 148 or section 280. Would the sanctioning authority have courage to not to give the sanction? Would he have? He cannot have, friends. This is nothing but a what should if I use the a little harsh word, it is nothing but a I was farce, or what should I say, is it a drafting defect? I think Mr. Jalan, you will agree with me that this is absolutely unjustified. It rather amounts to demeaning the approving panel, demeaning the approving panel itself. So friends, this is one thing which I noticed, I thought that let me place it before the this August House, that this in my opinion is a very important omission, or this provision should not have been there at all, friends. Then friends, another point which I would like to highlight is the provisions of section 275 of the Income Tax Act 25. Section 275, which is pari materia to section 144C. 144C of the Income Tax Act is equivalent section. It is written in the book also. Luckily, in the act that I have I think यहाँ भी आपने दिया होगा कि the corresponding section है वो दिया हुआ है. So 275 is, friends, is a dispute resolution panel, DRP short में. I don't know how many of you are aware about the DRP, the concept of DRP. Any of you have had any occasion to deal with this DRP? Good. So friends, DRP I will explain for those of you who may not have had the occasion to deal with it. My online friends must have had the occasion to deal with it, friends. The DRP is a provision which was introduced in the statute book in order to reduce the litigation in relation to transfer pricing cases, basically. Where you see when there is when there are, say, international transactions and the transfer pricing report in form number 3 CEB is required to be prepared, then the lawmakers thought it appropriate that let us give some, let us create some kind of a mechanism so that the assessment which is made in such cases does not result in demand immediately. Because you see, when an assessing officer makes an addition, huge demand is created and you are asked to pay 20% now. At least now 20% is what they want you to pay. And even then 20% is a huge sum. So the concept of DRP was brought in the statute book, that what will happen in such cases, the assessing officer will not pass the assessment order. What he will pass is a draft assessment order. That draft assessment order is not is basically an order, but that order without notice under section 156. Notice of demand will not be there. The draft order will be given to you, and once you receive the draft assessment order, you will have an opportunity to, you can do two things. Either you can accept the draft assessment order, in which case the assessing officer will pass the order, which is the regular assessment order accompanied with notice of demand, and against that assessment order you can then go in the regular way by filing an appeal which you are required to file. That is 246 and all those things are there. Or if you do not agree with the draft assessment order, then you can file an objection to the draft order. It's not an appeal, it's an objection. You can file an objection with the dispute resolution panel, which is DRP in short. And DRP, friends, this was also in our meeting, if you remember, one of the point raised was that DRP, there is no DRP in Calcutta. If you have to file an objection, you have to travel all the way to other benches, Delhi. So DRP now will look into your objections, and DRP will be given, DRP was given a time bound 9 months to pass the order, because the intention is that we want to reduce the litigation, so that you at least for 9 months you do not have the notice of demand. Only when the DRP passes the order, then the things will come. Now I'll explain you a few things which are copied from 61 Act in 25 Act. I'll say 61, 1961 Act and 2025. Now friends, DRP जो panel है, dispute resolution panel will consist of 3 commissioners. It is written in the section itself that the dispute resolution panel will consist of 3 commissioners. Okay, very good. Commissioners, very experienced people, and they will hear your objection. But friends, my objection to DRP is the DRP, friends, if you read section 275 subsection 8, 275 subsection 8 says the dispute resolution panel may confirm, reduce or enhance the variation proposed in the draft order. So, however, that it shall not set aside any proposed variation or issue any direction under subsection 5 for further inquiry and passing of the order. So, friends, the DRP has been given power to confirm, to reduce or to enhance. Power of enhancement is also there with DRP. Then friends, subsection 9, please see subsection 9. Subsection 9 of section 275 says, for the purposes of subsection 8, the power of DRP to enhance the variation shall include the power to consider any matter arising out of the assessment proceeding relating to the draft order, irrespective of the fact that whether such matter was not raised by the eligible assessee. That means it's a power to consider an issue which was not raised in the draft order. So friends, I think all of you will agree that what DRP is doing is nothing but a function of an appellate authority. It's nothing but an appellate authority function, which is being done by 3 principal commissioners. And friends, they have been given the power to enhance also. When you have given the power to enhance means they will fasten tax liability on you which was not there in the original order. Is it not? When they do it, friends, I say they are acting as assessing officer. They are acting as assessing officer. If you see the definition of assessing officer, DRP is not an assessing officer. Neither is the principal commissioner. If you read the definition of assessing officer in the new act also or in the old act also, assessing officer does not include principal commissioner. So friends, my submission is, when the principal commissioner has been given the power of enhancement also, is he not acting as an assessing officer? If he is acting as an assessing officer, is it authorized by the act? Because Article 245 of the Constitution of India says, no taxes can be levied except as per the authority of law. in order to demand any tax from me, there must be authority of law. Is it authority of law or not? I leave it to this august house as well as to the public at large, because in my opinion, the DRP, insofar as it has been given the power of enhancement or power to confirm, is nothing but acting as an officer. Moreover, friends, when I said that they are performing the role of an appellate authority, if you see the provisions of section 119 in the earlier law, which is now the new law, the relevant section, I will take you to the relevant section, the powers of the instruction to subordinate authorities, that is 239 under the new law, which is pari materia to 119 under the 61 Act. Friends, the section 239 deals with the instructions which can be given by the Central Board of Direct Taxes. Central Board of Direct Taxes, it says the board may issue orders, instructions and directions to income tax authorities as it considers fit for the proper administration. And the board regularly issues the circulars, notifications, etc. However, subsection 2 of this section, which is equivalent to earlier section 119 also, it says no order, instruction or direction under subsection 1 shall be issued so as to require any income tax authority to make a particular assessment or to dispose of a particular case in a particular manner. So mind it, even Central Board of Direct Taxes is not empowered to give any direction whatsoever to the income tax authority for making the assessment in a particular manner. The day in and out we see the commissioner will ask the assessing officer to meet him, and he will say verbally that don't do this or do this, but he cannot do anything in writing, because not even Central Board of Direct Taxes has the power to give any direction to the assessing officer to complete an assessment. Similarly, it says interfere with the discretion of the Joint Commissioner Appeal or Commissioner Appeal in exercise of the appellate function. So friends, when even Central Board of Direct Taxes is not empowered to give direction to the assessing officer, when you are asking DRP to give direction, is it not contradiction in itself? Again, friends, section 144C of the Income Tax Act, earlier do we have the 61 Act here? Is there? It's there. Okay. Very good. So, section 144, one more thing I will like to point out, friends. Yes, very good. 144C subsection 6 of the earlier Act, that says that DRP shall issue the directions after considering the following. Under the earlier or the present law, it says that DRP, the directions will be given by the DRP after considering draft order, objections filed by the SSC, evidence furnished by the SSC, report if any of the AO, valuation officer or TPO, records relating to the draft order, evidence collected by or caused to be collected by it, result of any inquiry made by it. So, even assuming but not admitting that DRP is functioning in accordance with law, the DRP was required to consider all these things under the present law before passing the directions. Now, friends, the same provision under the new law, it says the DRP shall issue the directions in writing stating the points of determination, the decision thereon, and the reason for such decision. All these things gone. So, they need not, earlier they have to consider the evidence, report, reasons, everything, specifically written, evidence furnished by the SSC, report of the AO, records relating to draft order, evidence collected by it or caused to be collected, everything they have to consider. Now they say 275 subsection 6, they will give the direction and reason for such direction. Reason for direction, friends, I was arguing a case last 2 days ago. In that in the order it was written, my SSC has given 10 pages in writings, the submissions has been made, and the assessing officer says his submissions are not sufficient and therefore I make the addition. So I was arguing, Lordship, it is not sufficient, but he must say how it is not sufficient. Simply saying that it is not sufficient cannot make my submissions insufficient. You must say how it is not sufficient, then only it makes a reasoned order. Otherwise you will say, no, I do not find it sufficient, that's it. So friends, in so far as this dispute resolution panel, the working is concerned, I think this is going to be though this DRP is functioning since long, and to the top of it one more flaw I will point out in this is, you see, DRP's order is even assessing officer can challenge. Though in the 275 it is written that when the directions are given to the AO, they are binding on the AO. He cannot do anything but to follow the directions. However, he can challenge this in the tribunal. This amendment was made in 2023 by the Finance Act of 2023, where the SSC as well as the assessing officer have been given the power indirectly. In section 253, you will not find directly the reference to directions of the DRP, but other order it is written. So, this is one thing, friends, which I wanted to highlight, which in my opinion is going to create trouble, friends. Now, let me come to another point which I want to highlight, is section 247 of the new act. Section 247 of the new act, friends, deals with search and seizure, which is pari materia to, friends, 132 of the earlier act. So, friends, in this section 247, no issue. You have volume 1. So friends, this 247 deals with search and seizure, and the provisions are more or less they are as it is as compared to the earlier section 132. Except that I find one thing to be very, very interesting is what they have done, friends. The provisions of section 247 deals with seizure, that when the search party comes, they can seize I will read the one earlier act first, then I will explain you the point which I have noticed and I wanted to highlight before this house, friends. Yes. Section 132, yes. Section 132, friends, it deals with seizure of any books of accounts, other documents, money, bullion, jewelry, or other valuable article or thing found as a result of such search. So obviously, if you during the course of search, if any undisclosed thing which is in the nature of these items which I read is found, then the search party has got right to seize that. But proviso, there is a proviso. Proviso says, provided that bullion, jewelry, or other valuable article or thing being stock in trade of the business found as a result of such search shall not be seized, but the authorized officer shall make a note or inventory of such stock in trade of the business. So therefore, suppose the search takes place at a reputed jewelry house, jewelry showroom, and the lot of things are found which are undisclosed. But for jewelry showroom, the bullion jewelry will be its stock in trade. So then the lawmakers have provided that stock in trade is not capable of being seized, because if it is seized, then I will be out of my business. That is the rationale, friends. Fair enough. The same provisions have been copied here also. However, what they have done is, friends, in its zeal towards, I can say that, in its zeal towards reducing the number of sections, reducing the number of words, they had made this, it appears. Because this jewelry, bullion, money was written several times in this search related provisions. So they have, what they did, they have made a definition section, which is section, the definition section is section 261, interpretation. And that interpretation section has been defines the meaning of the word asset. Asset is, now the definition of asset is, asset includes any money, bullion, jewelry, virtual digital asset or other valuable article or thing held in physical or virtual form. So instead of, because you see, if they would not have defined asset, they would have had to write this several times. So they have, in all those sections, instead of writing so many words, they have replaced it with asset. However, friends, when the stock in trade is being excluded, so they have said asset excluding stock in trade. Now what does that mean indirectly, friends? Because asset includes money as well. So you get me? Therefore, if money is my stock in trade, then that is not capable of being under the new law. Though one can argue money can never be stock in trade, but I can argue money is now, there are there are foreign exchange dealers, there are counters who are doing foreign exchange. At the airport you have foreign exchange dealers. You want rupee exchange of dollar, For them money is the stock in trade. So they will say that, look, you cannot do anything. I hope I am, you have got my point, what I want to highlight. So when the stock in trade was being excluded, the money has to be kept out of the stock in trade, I think. Otherwise, this will, a lot of people are going to say advantage or disadvantage. This is one thing, friends. And in 247, friends, they have now, since the day by day the world is becoming smarter, we are now using ChatGPT frequently. We are less on Google, more on ChatGPT now. So the government is also, they are also on ChatGPT. We should not think that only we are using it. They are also equally using it. And these days the kind of notices which are coming faceless, they are becoming smarter and smarter day by day in their queries, sir. It's no longer that standard notice. We used to complain that, look, it's a standard notice, 20 points, 10 are not relevant to me. But now they are only sending you the notices which are generated by AI. So they are also effectively utilizing. So friends, in 247 also, they have made amendments by the search and seizure can be even in relation to your cloud, the information which is on cloud. You may not have anything, everything is in your pocket and cloud, but that is also now can be subject matter of search and seizure, and they keyless access code. Only you know the code, nobody else knows. So access code is also included in the case of search and seizure. So basically, the provision has been now designed in accordance with the changes which are going on in the world at large, which is a good thing, I think. And then, friends, one thing which was debated in our last meeting also, that Black Money Act is also a ground for initiation of the search. Black money, undisclosed foreign income and assets, if there is anything related to that also is a ground for search under the Income Tax Act, which they have done, friends. Maybe good, maybe bad, friends. This is insofar as section 247 is concerned, friends. Then, friends, another important point I want to highlight is, which is again a point of litigation, and that is, friends, kindly come to section which is the (276), friends. (276) and 277. These two sections, friends, I want to highlight. These two sections deal with the method of accounting, which is under the existing law. It is section 145, method of accounting, and 145A, which deals with method of accounting in certain cases. And as all of us know, that ICDS was notified by the government a few years ago, and your return has to be in accordance with the Income Computation and Disclosure Standards, which is the ICDS, and several ICDS has been notified, though I think ICDS in relation to real estate has not yet been notified. So, insofar as ICDS is concerned, friends, as far as Income Tax Act 25 is concerned, we all know that none of the rules has yet been notified. Only the act is there with us. However, there are no rules, no schemes, no notifications, or even ICDS. I cannot presume that ICDS which has been notified under section 145 is the ICDS for the purpose of section 276 also. I cannot say so, though they may come and say that the same ICDS will be notified. But I think it is high time that it should have been notified, though it has not yet been. The issue with these two sections, friends, is, you see, as far as ICDS itself is concerned, that has been subject matter of challenge before the Delhi High Court in the case of Chamber of Tax Consultants, where Justice Muralidhar, who has now retired, he had given a detailed judgment where some of the ICDS were held to be ultra vires in that judgment. Chamber of Tax Consultant is a very famous decision, friends, Delhi High Court. This decision has not been challenged by the department in Supreme Court. So I say that that decision has become final, it has attained finality. Now you see, friends, in that decision, the ICDS 1 deals with significant accounting policy, which is the AS1, accounting standard 1 is it is equivalent to ICDS 1. Now friends, we have always, since our childhood school days, when we used to read the AS, accounting standard, and whenever we are preparing the audited balance sheet, in the notes on the accounts we have to write the significant accounting policies. And we always say that accounts have been prepared on mercantile basis, the prudent policies has been in accordance with prudence and all, that we write as a standard copy from year to year. But friends, the ICDS 1 says the policy may not be prudent. What does that mean? Because prudence means that all losses which you foresee, they have to be taken into account while preparing the accounts. However, the profits can be taken into account only when you are reasonably certain that the amount will come to you. Unless you are reasonably certain, you cannot take into account the profits while computing your income or while preparing your audited accounts, unless there is a reasonable certainty. There is a famous case, Surji Ballabh Das, 46 ITR, Supreme Court decision is there. That, however, friends, to the surprise of all of us, the ICDS 1 says that you need not follow the prudence. And one of the ICDS which deals with retention money in a construction contract, friends, those of you who may have dealt with the construction contracts, there is a standard retention money clause is there. That because in the, say, large contract, say building airport, 10,000 crore worth of contract. Now it will take 3 years to complete, and after whether the airport was built correctly or not, one will come to know only after 5 years. In 5 years there may be several difficulties. So therefore it is standard to have a retention clause that unless the airport is built to my specification, I will not pay you this much money, that I will pay you only after the end of particular period. And therefore, friends, the retention money is never taken into account while computing my income, because I am not sure whether I will be able to get that money or not. I will know only when it comes to me. And there is a decision of Calcutta High Court, Simplex Concrete Pile. Calcutta High Court has said that retention money is taxable only in the year in which you are either you are certain or you have received. then only retention money will be made taxable in your hands. However, friends, the ICDS on construction contract, if you see, it says that retention money will be taken to your income as and when it is generated. That means even if you have not received, even if certainty is not there, it will be added to your income. And what they say? They say that it can be claimed as an expenditure subsequently if you do not receive it. Friends, I am asking a question to myself. When you are saying so, do you guarantee that subsequently I will have income in order to claim that expenditure? That you presuppose that I will have income. But suppose I close down my business, then what happens? So friends, the provision is unworkable unless you allowed backward setting of loss, which is allowed in US. You are allowed backward setting off. In this kind of a situation, under the US law, your return for the earlier year will be allowed to be revised and your taxation will be reworked. Unless you allow me to do that, this is absolutely nothing but absurd. But that is there, and Justice Muralidhar in Chamber of Tax Consultant has said that no, this is ultra vires. This continues. Another example, friends, I will give you is the valuation of securities. In case of a stockbroker, the shares are my stock in trade. Shares, bond are my stock in trade. I am dealing with shares, I am dealing with gold, I am dealing with silver, I am dealing with ETF. There are different classes of securities. Now, in case of a stockbroker, the ICDS, there is one ICDS is there. That ICDS says the valuation of securities will have to be done class-wise. Class-wise means the equity shares, if I am holding 10 equity shares, then what it says that you have to add the cost of all 10 shares, you have to add the market price of all 10 shares, you have to compare the total of cost and market price and then arrive at the valuation, which is cost or market price, whichever is lower. Because inventory valuation, following the prudence, we value it at cost or NRV, whichever is lower. And it says that it has to be done class-wise. In fact, the provisions of section 277 subclause 3, it says that the comparison of actual cost and net realizable value of securities shall be made category-wise. That means for shares is one category, for ETF another category, for bonds another category. You will compare the cost and market price, whichever is lower, and then value the security. What does that mean, friends? It will give you absurd results. It will give you absurd results. Because what happens, if you do the calculation, I will not like to involve you because time is short. It will mean the profit of one company in which you have profit today, that will be set off against loss of some other company, and the valuation of stock will be higher without any guarantee that that price will be realized by you even after, even next day. Because in stock market, there is no guarantee that the value which you have, because you see now gold and silver, today the price is 1,50,000, tomorrow it may be 1,80,000 or even 1,20,000. Nobody knows, so much of fluctuation. So in securities, particularly in shares, you cannot have the valuation class wise, you have to value individually cost or market price, whichever is lower, in order to factor the losses which are there. But friends, somehow this continues in the in section 277, which is earlier section 145A. So friends, the ICDS has inherent defects which is being carried forward, even though the Chamber of Tax Consultant judgment is there, and for those who are those of you who are say acting as auditors or coordinating with auditors, auditors have very difficult task, because in the tax audit report you will be required to report on the implications of ICDS. What is the effect of ICDS on the profits and losses? If you report that, then invariably the same will be picked up in the adjustments, in the intimation which you get, it will get picked up. So friends, this section 276 and 277 is another point that I wanted to place before you, friends. Another one more section, important section, is 269. 269 is, friends, estimation of value of assets by valuation officer. See, this problem is being faced by everybody. And everybody in his lifetime, be it individual, be it a company, anybody, all of us say at some point of time, we may have bought immovable property, a residential house. And now you see, friends, the residential house, as all of you know, under the new existing law, section 50C is there and 56(2)(10) is there, and the stamp duty value is compared to the transaction value, and the same is subject matter of adjustment and additions, etc. Though you have an option of referring the matter to the valuation officer, you can say that the valuation value which the stamp duty value is not a correct value, I object to it, and the officer is mandatorily required to refer the matter to the valuation officer. As far as valuation officer provisions are concerned, in the existing Income Tax Act, the reference to the valuation officer was through Wealth Tax Act. Certain sections of Wealth Tax Act has been referred in the present law, though the Wealth Tax Act has been abolished long ago. However, now they have corrected it and they have refined the valuation officer in the act itself. However, friends, my concern is that the valuation officer, whenever he does the valuation, he will give the valuation report to the assessing officer, and the assessing officer will then take it forward. There is no right of appeal provided against the valuation officer's report. You do not have any right of appeal. Whatever he does, you have to indirectly appeal against that in the form of challenging the order of the assessing officer, or you have to file a writ petition against the valuation officer's report in the writ court under Article 226 of the Constitution of India. Now, even though the valuation officer under the Act, section 269, you see the valuation officer has the power as are vested in a court under the Code of Civil Procedure. So, he has the powers of a court when he is coming for valuation, but there is no corresponding duty involved. The powers must be given with corresponding responsibility. That is what I am trying to highlight. Here only power is given, but duty or responsibility, because when you are challenging the report of a valuation officer through the assessing officer will say, "Arey, main kya karu? What should I do?" He has given the report, but the person who has given the report, he is not there to say. So there should be a right of appeal against the valuation report itself. Otherwise, the assessing officer will pass the order on the basis of that, and the demand will be created. Whereas if the valuation officer's report itself could have been the subject matter of challenge, then that could have been avoided, friends. This is another thing which I wanted to highlight before you, friends. These are the major points which I found, which I think some of them were there in the existing act also, and some of them I have pointed out new points, like the approving panels directions being subject matter of the approval by sanctioning authority, who is much lower. That is so friends, these points have been carried in the new law. Some of the points have been carried in the new law, which were there under the old law also. So therefore, friends, that means when I started the session by saying that it's a old wine in a new bottle, that was the reason that I thought that it is a old wine in a new bottle. The intentions no doubt are good, to reduce the number of sections and to reduce the words. However, even though with good intentions, as a lawyer, as a chartered accountant, I can say that it is going to be there are going to be litigations and disputes even under the Income Tax Act 2025. Then, friends, there are few things as far as the changes which are there. What I pointed out was so to say, the inconsistencies or defects which are there in my opinion. But as far as changes are concerned, which are when you compare the bare act of these two provisions insofar as the 100 sections which I had the occasion to refer, I will touch upon that also, friends. The one of the things that, friends, one of the changes in section 246 of the Income Tax Act, friends. 246 is basically pari materia to section 131 of the Income Tax Act. Someone under 131, all of us at some point of time may have had the occasion to get a summon for client or for ourselves also, where the assessing officer gives you a summon that you appear before me to give a statement in person or through an authorized representative, and if you do not do, then I will impose a penalty of rupees 10,000. Some of us say, okay, you impose 10,000. It is cheaper than attending before you. So, in so far as 131 or 246 is concerned, friends, the change is that in relation to the search which is being conducted, the law does not provide for issuance of the notice under section 131 during the course of search. As and when the search is progressing, in some cases it can be for say 2 days, 3 days also continuous. So they have now included the power to issue summon even when the search is continuing, which is I think it is not that nothing much, or because in any case that power they can exercise at any time. That is one change which has been done, friends. Another change which has been done in relation to search provisions only is that after the end of the search, the authorized officer has to hand over the entire material within 60 days at present, within 60 days. That time limit has been increased to 180 days. Time limit is 3 times. Another change is in the survey provisions. Survey is done under section 133A at present, which is at the business premises. The officer can visit after sunrise and before sunset, or at any place where charitable activities are carried on. The power of survey is there under section 133A, which is copied in section 253 of the Act, new Act. Here there is a provision under the in 133A regarding the recording of statement, that when he comes he will record the statement that okay, give me a statement, your stock, how much stock you have. So the person will say okay, I have 10,000 pieces of this thing. They will count and they say there is a difference, explain the difference. Then he will say the purpose of recording a statement in any proceeding is that that statement can be utilized subsequently, because at the spur of the moment whatever I say, that is supposed to be correct. I cannot make stories at that point of time. Subsequently I can change, I can retract from a statement. So in these cases what used to happen, the statements were challenged, that look, the statement was not given under oath, that I have not taken oath that I am giving true and correct statement. So therefore this statement is of no value. So now they have done is, they have included the word under oath. So when the statement is recorded during the course of survey under section 253, now they will say that I am giving you are taking oath that the whatever you are saying is true and correct. जो हम लोग कोर्ट में गीता की कसम खा के कहता हूँ कि मैं सच कहूँगा, सच के सिवा कुछ नहीं कहूँगा. So वो statement under oath, that has got the evidentiary value of the statement under oath is more than the statement which is not under oath. This change they have made in so far as the provisions of survey is concerned, friends. Then another change is made in the special audit, and now under section 142 of the Income Tax Act, the assessing officer has the power to direct a special audit if he is satisfied that the audit which has been conducted is not properly done, or if upon scrutiny of the books of account he finds that no, there are a lot of complications, then he can direct a special audit to be done by the auditor to be appointed by him. That provision is there in section 142(2)(a), where earlier what used to happen, the special audit was being used frequently because the department did not have to pay the special auditor's fees. It was the assessee who had to pay the fees. So there was objection. So now the special auditor's fees is required to be paid by the commissioner. So they don't give directions unless it is genuinely required. For that special audit, the time limit has been increased, because now it is 6 months from the end of the month in which direction is given, as against earlier 180 days, which is there at present, friends. 6 months from the end of the month. Then friends, this I have done, 280 is okay, 285 is done, and 286 friends is the time limit section, which is 153 of the present act. There the reference to the reference to 12 months has been replaced by 1 year. Instead of 12 months, they are saying 1 year, which I think 12 months and 1 year, unless the February month, that 28, 29, that must have gone into the things. That is one change, friends. These are the only changes which has been made, which requires discussion, I think. Otherwise, in any of these provisions from section 236 to section 331 or 332, which I have covered, there are no other changes. And one change which is across the board is they have reworded the phrase non-obstinate clause, notwithstanding anything contained in any other act. They have said irrespective of anything contained. That change is across the board, friends. So that appears here also everywhere. That's it, friends. Now I open to questions, if any.
Okay, any questions from any participant?
So whether the report can now be challenged as a writ petition before the court?
Yes, definitely.
Still it can be challenged?
Yes. Valuation officer's report you can directly challenge in a writ court.
Even after this amendment?
Writ court jurisdiction is always there.
Okay.
Whether it is provided here or not, you can challenge before the court.
So what makes it this different?
No, the difference I am trying to highlight, that when the new act is coming, in order to simplify, then valuation officer has been given the power of a court to enforce the attendance. He can visit your place, he can enter your house, your office, your aircraft, your motor car, anywhere he can come for the purpose of valuation. His powers are immense. One more thing I wanted to, I was thinking in my mind that look, valuation officer, the definition of valuation officer is there in the act, but that definition is valuation officer as appointed by the central government. But there is no qualification as such for a person to be a valuation officer. Anybody can be appointed a valuation officer. So when you are giving him the powers, then corresponding with that power, whether he is doing the act properly or not, that must be there. How it will be ensured? When that his actions are appealable. When you can file an appeal against the report of the valuation officer itself, that is a reasonable thing. But now the law provides that the valuation officer will give the report to the assessing officer. Assessing officer will follow with blindfold, he will follow the valuation officer. If you don't think that the valuation is correct, you have to then, you have at that point of time to appeal against that assessment. Appeal means demand will be there, 20% of the
demand payment.
Now in Calcutta, friends, you will agree that what is happening, one of my friend is buying a property at a very reputed complex, where his transaction value is 4 crore, but the circle rate is 6 crore. What does he do? he has to pay 7% on the difference of 2 crores, which is the stamp duty. That is one. Secondly, the income tax will charge section 56 to 10, because 6 crore, they will take 6 crore, but the transaction value is 4 crore. So friends, this is a very, it is affecting everybody. Even those who are making the assessment, it is affecting them also. Yes.
Thank you.
Any other questions? Sir, I have one question on the summon. You explained very nicely on section 131. Now, I understand that there are various judgments which says that if an officer calls you for summon and if he is duty bound to be available himself. But nowadays, many of the times when we appear before someone as an AR, officer himself is not there, and then we write. We put it on record, we came, submitted so-and-so documents. Can this be challenged and can the whole procedure be quashed if the officer is not available on the first day when he called for summons?
No, in my opinion, if the officer is not available once, then that cannot be a ground of challenge, because it can always happen. Say once he has called you, but for some reason he is not there, and I think the courtesy demands that if he is not there, I think he should either inform you, or he should send you a adjournment kind of a mail that you don't come today, you come some other day. That is the courtesy. But if he repeatedly does so, then of course you can simply write that I have appeared thrice and I will no longer do it. If you have anything to ask me, I will give you information, you can ask me. That can be that is reasonable. He cannot say that no, you keep on coming and waste your time, and I will. And nowadays, for all of us, this thing is, we can avoid that. We can ask that you give me virtual appearance, I will do virtual. So that you give me the link, I will appear at dotted time. If you are not there, well and good.
We can appear because they...
for someone, we can, in such cases, we can say that you give me a virtual appearance, I will appear virtually.
But then that is as per IPC, no? You cannot move without the officer being satisfied.
But here, since the officer is not himself available, what we can do?
Right. Any other question, online participants? And then from the chamber also, we also represented. So luckily that provision has been deleted once this act was notified. Okay, so in case there are no other questions, I think we are almost done on time also. So thank you, sir. Thank you a lot for this wonderful deliberations, and not only what are the changes in the assessments and other procedures, but also on things like ICDS, you know, wherever ICDS goes against the business. So possibly what has now enlightened to all the participants is they can even try and challenge the ICDS on this Delhi High Court judgment, which you rightly pointed out has not been challenged by the Income Tax Department, and so it has achieved finality. So you touched upon other very, very important, crucial points on DRP. I think, sir, I have not seen any positive order from DRP. And now with this vague, duties, I would say, they will not look at draft assessment order, etc. Just conduct an inquiry, as it is the inquiry conducted after seeing the submissions also, it becomes, I hardly see any positive demand. And problem rightly in Calcutta, which you pointed out before the honorable member, from Calcutta you travel to Delhi and whole day you sit outside, and another day it will spill over, another day it will spill over, so it becomes a problem. So once again, thank you very much. I think the participants are highly enlightened by your deliberations. Thank you, sir, and we look forward to your support in our future endeavors of the chamber. Over to Sharbani.
Thank you, sir, for joining us today. And thank you all the participants who are present over here and the participants who have joined online. We will have our next class on Thursday from 5:30 to 7. And we will share the link with the participants separately. And I will also intimate the physical participants who are here over mail the details. Thank you. Thursday, 5:30 to 7. So, yes, Thursday, 5:30 to 7. Even Friday also, 5:30 to 7, both the days.